Stop what you're doing right now. If you hold any industrial turnaround stocks, or honestly, any tech crossover stocks in your portfolio, you absolutely need to see this breakdown. Welcome to The Explainer. So last week, I ran a 56-year-old company called Helios Technologies through 5 distinct valuation models and 2 legendary investor checklists. And guys, what I found completely shocked me. See, right now, the broader market is entirely mispricing this company. They're treating it like some boring, slow-growth legacy machinery stock. But what if I told you their intrinsic value could be radically higher because they're actively morphing into a stealth data center liquid cooling play? I mean, no way, right? Look, I know exactly what you're thinking. We all know the biggest fear for everyday retail investors, buying into a massive, hyped-up tech narrative right before the floor completely falls out and leaves you holding the bag. It's the ultimate pain point. But if a legendary investor like Peter Lynch were looking at this exact stock today, he wouldn't run away. He would zero right in on their dramatic recent margin expansion and try to figure out if that hidden tech angle is a genuine catalyst or just corporate noise. And that brings us to a highly surprising, honestly almost jarring statistic from this recent earnings cycle. We are talking about a massive 64.5% trailing earnings rebound. Just to put that into perspective, think of this company like a heavy-duty industrial tractor that was stalling and sputtering in the mud for 5 long years, but just got secretly injected with a massive shot of high-tech nitrous. This stock's earnings just exploded over the trailing 12 months, and that exact unexpected momentum is what fueled a staggering 95% stock surge last year alone. So that brings us to the bold, central question we are going to be unpacking today. Can Helios Technologies actually maintain this massive momentum? Are we looking at a sustainable, fundamental turnaround that actually justifies a premium price tag, or is this just a temporary spike and a longer-term downward slide? I promise you, by the end of this explainer, you're going to know exactly what the data says. I'm going to give you a clear, actionable framework you can literally steal to determine if this stock is a Buffett buy, a durable Peter Lynch multi-bagger, or just a classic value trap. Here is exactly how we're going to break this all down. First, the turnaround story. Second, unpacking Q1 2026 earnings. Third, the core 2030 strategy. Fourth, dividends and capital allocation. And finally, the valuation debate. Section 1. The turnaround story. Reversing a 5-year decline. To really understand why those recent numbers are such a big deal, we first got to zoom out and look at the historical context of the company's performance. And man, it is a stark contrast. On one hand, you have this multi-year struggle, a 20.2% annual earnings decline over 5 solid years. It's rough. But then, look at the other side. A sudden, sharp 64.5% growth over the trailing 12 months, with net income hitting $60.8 million. It's like a completely different company. Now, if you're a bull, you see a business that's already operating at a higher run rate, totally leaving that multi-year slide in the rearview mirror. But if you're a bear, that 20.2% historical decline is a giant flashing warning sign, making you really question how durable this new growth path actually is. Moving right along to Section 2, unpacking Q1 2026 earnings, hydraulics versus electronics. Let's dig into the specifics of Q1 to see exactly what's driving this crazy run. Because management actually called this one of the highest sales quarters in their entire 56-year history. So looking at the official 10Q data, breaking down that consolidated $228.4 million in sales lets us pinpoint exactly where this growth is coming from. And the cool thing is, both segments are really pulling their weight here, leading to a consolidated sales increase of almost 17% year over year. That's huge. Let's get a bit closer to those segments on a pro forma basis, adjusting for foreign exchange and a past divestiture. We're seeing a really solid 19% pro forma growth in the hydraulics segment. But wait, look at the electronics segment. It is contrasted beautifully with a massive 29% surge. And here's the kicker. This isn't just basic machinery anymore. This growth is being driven by higher demand in specialized, higher margin markets like health, wellness, agriculture, and recreational vehicles. And crucially, this revenue growth actually translated right into profitability. Gross margin expanded by 220 basis points to 32.8%. How'd they do it? Well, higher volumes definitely helped, giving them that sweet fixed cost leverage. But management also really executed on regional production efficiencies. They scaled back their engineering center and consolidated production facilities in places like Toledo and Tijuana to drive down the direct labor percentage. Bottom line, they are getting leaner as they grow. All right, Section 3, the Core 2030 strategy, doubling down. With Q1 setting such a strong foundation, management is definitely not sitting still. At the recent Investor Day, they laid out this highly ambitious long-term strategy that they're calling Core 2030. And the headline goal of this strategy is frankly staggering. They basically want to double their annual revenue. They are targeting a massive jump from roughly $792 million in 2025 pro forma sales all the way to $1.6 billion by 2030. Oh, and alongside this, they're aiming for adjusted EBITDA margins of 25% or more. Talk about swinging for the fences. So how on earth do they plan to get there? Well, this target relies heavily on operational excellence and a massive $60 million in new business wins they've already secured in 2025. But here is that technological hook we were talking about earlier. They are leveraging their acquired Faster business unit, which sits right there in the electronics segment, to penetrate the rapidly expanding data center liquid cooling market. They literally already have a product tested and OEM discussions are actively underway. This right here is exactly where the narrative shifts from just an industrial manufacturer to a legitimate tech-adjacent growth story. Section 4, dividends and capital allocation, enhancing returns. Now, as the company scales its operations and chases that $1.6 billion target, it's also making some really aggressive moves regarding how it manages its capital and rewards its shareholders. Tracing their history, Helios has an incredibly consistent track record. I mean, they have maintained a 29-year streak of consecutive quarterly dividends, stretching all the way back to 1997. Over the last couple of years, they prioritized cleaning up the balance sheet, paying down $158 million in debt. Now, feeling super confident in their Core 2030 cash generation outlook, they just declared a massive 33% dividend increase in Q1, bringing it up to 12 cents a share. But they're being smart about it, carefully balancing this dividend hike with continued debt reduction. In Q1, they brought their net debt down to $284 million, which drops their leverage ratio to 1.6 times. That is the lowest it's been since the first quarter of 2018. And, at the very same time, they successfully deployed $4.6 million for share repurchases. So we're seeing a very active, multi-pronged approach to capital allocation here. Which brings us to Section 5, the valuation debate, bull versus bear. We've seen the strong Q1 execution. We've seen the ambitious 2030 plan. Yet, the market remains heavily divided on how to actually value Helios today. Let's look at both sides of the coin. The bullish view anchors heavily on that recent margin expansion, 4 consecutive quarters of it, by the way, plus the incredible earnings momentum and that future data center liquid cooling tech opportunity we just talked about. Bears, however, they're pointing straight to a lofty 42.2 times price-to-earnings ratio. That is a massive premium when you compare it to the U.S. machinery industry average, which sits around 27.1 times. Bears are also pointing to that broader 5-year historical earnings decline, the slower 2.7% overall revenue growth forecasts, and the company's own mention of ongoing tariff uncertainties. As one financial analysis perfectly summed it up, investing at these premium multiples requires strong confidence. You really have to believe that the recent turnaround, the new operational efficiencies, and these new market penetrations are going to completely outpace the longer-term structural concerns and those modest near-term revenue forecasts. It's a high-stakes bet. So, as we eagerly anticipate their next earnings report, you really have to ask yourself, which metrics will ultimately prove the case? Are you going to be watching to see if adjusted EBITDA margins hold above management's 19.5% guidance floor? Will you be looking for updates on those critical data center OEM discussions? Ultimately, is Helios Technologies a durable growth story or just a stock priced for perfection? Keep a really close eye on that sales funnel conversion. It might just hold the answer. Thanks for joining me on this explainer. And remember, always keep questioning the data.